Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, April 16, 2010. The main story today was that U.S. equities slid sharply in New York morning trading as SEC charges were brought against investment banking giant Goldman Sachs. The SEC charged that Goldman with defrauding investors by omitting key facts about a financial product related to subprime mortgages. Goldman Sachs failed to disclose that Paulson & Company, a hedge fund, played a role in structuring the securities and taking a short position against the collateralized debt obligations. The Goldman stock price dropped 13% on the day, and it led risk aversion to intensify, which we had already seen in the overnight session. The increased risk aversion boosted the yen and weakened higher yielding currencies like the Australian dollar and European euro. Let's first take a look at the euro-yen pair. As we can see, the yen gained following the Goldman news. We had already been moving in favor of the yen in overnight trading as the euro was pressured by continued worries about Greece and other periphery countries in the eurozone. And we had tested the 125 area prior to the New York Open. And following the Goldman news and the slide in U.S. equities, we had a sharp move back down, all the way down to 123.85. So that brought us pretty close to our low from April 8th, around 123.40, though we did have a small counter rally in the New York afternoon session. If we zoom this pair out, we see that we could be developing into a double top pattern in this pair, as with 127.60 acting as resistance. So we would need the pair to move below this low in order for it to be a true double top. We could see that we had rallied in this pair from March 25th when we were at 120.140 up to our high around 127.60, and really the high we had was 127.90, and now we are correcting that rally. So let's throw a little Fibonacci retracement to see how far our decline has gone, and we could see that we bounced up off the 61.8% area. The dollar-yen pair, meanwhile, broke to a new low for this week, as well as it pushed below 92.55, which was our low from earlier in the week, and we had set up just above that level prior to the New York Open. We had seen this pair in a bit of consolidation with this low from Wednesday and our high around 93.70 containing the price action of the last 6 trading sessions, but today we had a move to the downside, which extended this decline that had started around the 94.60 level after the dollar-yen pair had seen this rally starting on March 21st. If we plot a Fibonacci retracement of this move from March 21st up to here on April 5th, we could see that today we slid below the 50% area, and now that 50% retracement is acting a little bit as resistance. So we'll have to see how investor sentiment continues after we come back from the weekend, and if we have a further move to cut carry trade pairs, which would mean further gains by the yen. So we saw that the yen was a big gainer in today's trading, and one big loser were gold prices. Gold took a tumble, as we can see in today's trading, sliding from a high of around 1,160 down to 1,129, so a drop of $30. Here too, we had a rally that started around March 25th and went through April 11th, and in the middle of the week, after a decline following this high that was set here, we had been trading sideways, but today we broke to the downside, that little consolidation zone. And that also coincided with this upward sloping line of support being broken, as well as our 200 period moving average in the 1 hour time frame. So all those bearish technical signals lined up with the poor fundamental news and the risk aversion to drop gold downward. We also saw a pretty sharp slide in oil prices in this heightened risk aversion atmosphere. Taking a look at one of our main commodity-sensitive currency pairs, the US dollar Canadian dollar, we saw a sharp reaction to the decline in commodity prices as we surged from the 1.005 area up to 1.0162. The pair broke above a downward sloping level of resistance around that 1.05 area, and then it broke above a horizontal line of resistance at 1.01, retested it briefly, and then shot further up. That broke the pair out of its own consolidation, or at least sideways trading that we have seen since we tested the parity level, though we did dip below parity to 0.9950. Plotting a Fibonacci retracement of this down move from 1.03 to 0.9950, we see that today's move met resistance just below the 61.8% retracement area. While we look set to close above the parity level for a second week in a row after testing it, we'll see how, again, investor sentiment returns following the weekend, but we also but the Canadian dollar is supported rather well by its fundamentals. And on Tuesday, we have the Bank of Canada deciding on interest rates. So if there is a very hawkish statement, we should see the Canadian dollar continue its gains against the greenback. As I had mentioned, we had worries over Greece and other periphery Eurozone nations in overnight trading, which pressured the euro-dollar pair, and then the euro fell under further pressure as risk aversion dominated the markets in the New York trading. The euro-dollar pair fell to its 200-period moving average, looking at 1-hour candles, and we also were able to close the gap that we had opened this week with at the 1.35 level, and we actually moved a little bit below that as well. Zooming this pair out slightly, if we plot a Fibonacci retracement of our rally from 1.3280 up to 1.3690, we see that today's support came at about the 50% level, so we have retraced 50% of this move. If we open next week with the pair pushing lower, we could see a retest of this support level just below 1.33, while on the upside we have this 1.3650 horizontal resistance to look for. With our market highlights out of the way, let's have a look at a couple of U.S. fundamental releases that came out today. First, we had housing starts jump in the month of March, with starts climbing to a 626 annual pace from a sharply upwardly revised 616,000 pace in February. Building permits, which are a sign of future constructions, also climbed, posting a 685,000 annual level. And this was actually the highest level since October of 2008. So this is a good sign for the construction sector, but with a big foreclosure problem still looming in the US, it will be interesting to see who will be actually buying all these new homes. In a second report, which added to the down mood in US equities, was today's preliminary UMich consumer sentiment for April, which disappointed forecasts and dropped to 69.5 from March's 73.6. Expectations had the index rising to 74.7. The current conditions index fell to its lowest level this year, while the index for expectations posted its weakest reading since March of 2009. We also see that consumer confidence had been stable in this lower 70 level, but today we see that consumer moods fell to their worst in about 5 months. So a mixed bag for US data, as we had a better than expected housing report, but a weaker than expected consumer confidence report. Now let's take a look at next week's key releases. From the US, it's going to be a rather light docket, especially for the first half of the week, as the only main release will be Monday's measure of leading indicators. That will be followed on Thursday by producer prices and existing home sales, and on Friday by durable goods orders and new home sales. So some more housing data as well as prices and manufacturing. Around the world, Tuesday we're going to get consumer price data from the UK, the German ZW Economic Sentiment Index, and the Bank of Canada interest rate statement. Wednesday, the UK posts its monthly jobs data, the claimant count change. Thursday, the UK will release data on retail sales, while the Eurozone will post its flash manufacturing and services PMIs. And on Friday, we wrap up the week with German IFO business climate, the UK first quarter preliminary reading of GDP, and Canadian measures of consumer prices and retail sales. And that will wrap up our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site, FXTimes.com. I want to thank you for watching and wish you a good weekend.